We have entered a very interesting time frame in which reality doesn't matter, but in reality it does. Does that make sense? Of course not. But that's what we have to deal with. The tsunami of bankruptcies and failures of all kinds are not only being warned of, but have already been showing up. Nobody seems to care because the market is so hot. Jim Cramer says that all we need to get us through until the end of the year, when the magicians will supposedly have the fix for this crisis here in 2020, is to print more money and increase deficit spending. Wow, what a load of garbage on all fronts. You came here for the truth, so let me unveil that for you. Today we're going to get into what you need to know. I'm talking about a tsunami that's coming. If you look at the previous video, I used the word mega bankruptcies, and every single day I see these messages, you're a fearmonger, you're this and you're that. It's right from a Bloomberg article. I'm going to show you right now what's happening. It's so key. We're going to talk about that first. I want to get into it in depth. Then we're going to look at what's happening with another airline talking about laying off tens of thousands of people. I want to show you what's happening on so many different levels. I've got a lot to cover, so let's begin. Professor whose formula predicts bankruptcies has a big warning. Companies seem to be exploiting market rebound, Altman says. Global corporate defaults on track to exceed 2009. That's according to Fitch. I have talked about this over and over and over again. I have highlighted this on so many videos. I keep getting into these issues because you can see it before it happens. It doesn't necessarily mean that that will be the linchpin. It doesn't mean that that will be the reason why there's a problem. But it's key. It's important. It needs to be understood so that as everything is falling apart, you're already one step ahead and you can see everything falling into place. But if you're not paying attention, if you're looking at PE ratios and 200-day moving averages and what the hot stock is today, you're not going to see this. And that's why I'm really glad that you've tuned in. The New York University professor who developed one of the best-known formulas for predicting corporate insolvencies has a warning for U.S. credit investors. This year of spate mega bankruptcies, remember, right from the Bloomberg article, is just getting started. This is what I have highlighted previously and why it's obvious. The issues here are only beginning. Don't think that, well, there's going to be a V-shaped recovery and Amazon stock is going to hit new record highs, so there's not going to be an issue. No, it doesn't work like that. It never has and it never will. This is so key. More than 30 American companies with liabilities exceeding $1 billion have already filed for Chapter 11 since the start of January, and that number is likely to top 60 by year end after businesses piled on debt. Companies globally have sold a record $2.1 trillion of bonds this year, with nearly half coming from U.S. issuers. And this is when the Fed had to step in and buy it all up. They started with the ETFs, then they go in individually. We are seeing all of this information right now, and we know it's not good. They knew exactly what would happen, just as you and I did. The fallen angels were going to be a problem. They realized that that would unwind the whole system, so they simply said, we'll buy it all up. They did so, and then you had other investors coming in, basically trying to copy them, and everything turned out a-okay, except the fact that they can't stop these bankruptcies from happening. And of course, we had the ripple effect of all of that. How many jobs will be lost? How many businesses shut down, resulting in other businesses shutting down, or at least have an impact? And that will, of course, take out the engine of the U.S. economy, which, of course, is that 70% consumer spending. We all know about that, and you're going to have an issue. There's no doubt about it. Chart at the top, companies around the world have sold a record amount of bonds this year. Of course, this will go up as long as they can. If the Federal Reserve is going to buy it, why not do it? Companies that are sitting on, let's say Apple's case, $200 billion of cash. Do they use that cash to buy their shares? No, they issue debt. They're doing it through debt. Why? Because the system works so well for them. It doesn't matter if they have $200 billion just sitting there. They're not going going to use that cash. Borrow while it's cheap. Except you've got a big problem, not just with Apple, but any corporation that consumes too much debt, and that's what he talks about. While the stimulus-fueled rally in credit markets since March has helped borrowers stay afloat during this crisis, Altman and others have warned that many companies are just delaying an inevitable reckoning. Fitch Ratings estimates worldwide corporate bond defaults this year could exceed levels reached during the global recession in 2009. Of course, it has to, just the way that we are going. It won't end well. Now, how many of the biggest of the big companies will be affected by it, that remains to be seen. And the impact on them is extremely difficult to tell because it will be in the ripple. It's not going to be necessarily a direct hit. There was a huge buildup of corporate debt by the end of 2019, and I thought the market would gain some much needed deleveraging with this crisis. Now it seems like companies again are exploiting what seems to be a crazy rebound. Of course they are, and I'm really, really glad that somebody is pointing this out and that it is actually out there, though we're not on the front page news. So you and I at least can talk about it. A couple more points before I want to move on to the next one. The speed and magnitude of the increase in corporate debt this year poses various risks to an already fragile global economic outlook, but these companies don't care. They're just going to do it anyway. They're going to push it to the absolute maximum. That's where we are at in 2020. Always take the risks, always use margin, always use leverage, maximum debt, and just go pedal to the metal and hope that the Federal Reserve or the government will bail you out. This is a very stupid strategy, but hey, so far it's working. In the US, the Federal Reserve has provided unprecedented support, such as buying corporate bonds, including the debt of firms that were cut from investment grade to junk. I just want to interject for a second right here. If you remember that I specifically had talked about the triple B bonds on so many different videos, I highlighted it many times before. And what I said was that as soon as they go below this line, they are considered quote unquote junk. When they make it into their funds, have to sell it. When they do sell, you have a cascading event. It's going to create a whole bunch of problems. So the Federal Reserve went in and started to buy it all up so that they can prevent this from happening. But now they're left with all this junk. And if these companies go bankrupt, if these companies start to default, if they have problems, now the Federal Reserve is on the hook for all this garbage. And you got a whole bunch of people following everything that they do. And now they are on the hook for it as well. It's a very bad policy to be supporting companies like this. I could understand you want the AAA and so on. Good, fine, whatever. But you're going to buy junk debt. You're going to support these markets, and it's going to create a problem later on. It's not going to be a problem necessarily for the Federal Reserve, but people are going to copy what they do. You're going to copycat all of it. And of course, you're going to have losses as a result. At the bottom, companies are doing the opposite of what they should be doing, which is to deleverage in the banks, as the banks did during the global financial crisis of 2008. Quote, when there is an increase in insolvency risk, what you do not need is more debt. You need less debt. Exactly. It's such a simple thing, and yet they don't do it. They maximize the debt and the leverage. Look at where people are doing now. I see it all the time. I maximize my leverage. I use as much as I need to. I will do everything I can. You see the margins start to pick up. You look at what people do, and it's always about taking risk because everything is all good in a bull market, and then suddenly they get smacked in the face and they wonder, what the heck was that? Okay, so check this out. There are more signs of possible trouble ahead for the high-flying technology stocks, this time from gauges of expected volatility. I've shown you the VIX index. I've shown you the MOVE index. There are so many others out there. Check this out. One alert stems from the widest spread since 2004 between the CBOE NDX volatility index, a measure of implied equity swings for the NASDAQ, and the counterpart so-called fear gauge for the S&P 500. So essentially, the volatility of the NASDAQ and the volatility of the S&P 500, okay? Another comes from unusual simultaneous gains in the technology index and the NDX recently. This kind of pronounced shift in the relationship between the two volatility indexes tends to correspond with absolute and relative underperformance on the NASDAQ, particularly over 3 months. What we have here today, of course, is so much money going in because of what was happening. People were looking for areas in which they can park their money. Retail investors got into it. The central banks, of course, did what they had to do, and you have what could be seen as an overvaluation of particular stocks. You can see this on different scales. There are so many ways to do it. You can look at the RSI. You can see it based on a number of things. Anyway, but in this case here, it's just showing you historically things are completely out of whack. This is the chart that corresponds to that, and you could see shooting higher. NASDAQ 100 volatility gauge is the highest versus the VIX since 2004. It's usually not a good sign, so let's see what happens. That's all for this video. If you found it informative, hit that thumbs up button. If you hate me, if you hate my face, if you hate my voice, give it a thumbs down. Share your opinion. If you want to check me out, Instagram, Twitter, The Money GPS. If you want to learn to sell stuff online, the AmazonGPS.com. If you want to know the truth, not the sugar-coated garbage that you got everywhere else, check out my books, link in the description. If you want the audiobook, themoneygps.com. If you haven't watched this video yet, I get into the mega bankruptcies here. Definitely watch it, click it, see you there.